Robschild, no investment advice. I decided to do a separate video this week for the daily reminders because I forgot to include it in Monday's show. I may continue this format in the future, not sure. I used to do the daily reminders in every show, and I got sick of repeating myself so much I decided to just stick it to Mondays. But I think that it would be a huge error to consider any of these things to be unimportant or to forget about them when we're making our investment choices. Knowing where we are in the bigger macro picture is easy to forget and massively important to not forget on a daily basis. This mini daily reminder show is for the week of Monday, October 28th, 2024. Again, they've turned into literally weekly reminders, but they should be interpreted as daily reminders. So let's begin. Daily reminder number 1, the 2-year, 10-year Treasury yield curve, or Treasury yields were inverted for more than 2 years, bull steepening reversion starting in September 6, 2024. The last time we had an inversion like this for this long was directly before the Great Depression. This is not something to take with a grain of salt. This is something to be taken without any salt. This is a gigantic red flag by itself. But it doesn't end there. The Somme rule was triggered in July of 2024. Every time that this has been triggered in the past, it has led directly into a recession. Now, although unemployment currently is low, although later this week, I believe it's on Thursday, we hear an update to this report. Although it's only 4.1%, it has risen enough to trigger a rule that says we are going into a recession. The direction and the speed of which unemployment is going up says we're headed into a recession, or we're actually already in a recession. So that's red flag number 2. Next up, the S&P 500 currently has a PE ratio of 30. Looking at a chart from multpl.com of the S&P 500 PE ratio going back to 1870, you can see on this chart that it is not typical to ever really go above 20, except for more recent history in a lower interest rate environment. And now we're sitting at a PE ratio of 30. This is all while, by the way, the 10-year yield is currently above 4%. And that's not a terribly low yield on Treasury bonds. So that's a double whammy, saying that this PE ratio is saying that stocks are extremely overvalued. But Robschild, I see this chart, it's going up plenty of times before. Even in 2020, it was like way higher. Well, that's because of something called earnings contraction. When companies earn less money, then it also sends the ratio higher. We haven't even had the earnings contraction yet. If that happens, yes, the PE ratio will shoot up, but that's like the opposite of a good situation. That usually occurs actually when the market's also crashing at the same time. The ratio includes the price and the earnings, not just one or the other. And in this case, it's the price that is getting way ahead of the earnings. It's currently super, super far ahead in its earnings. I did add something for this show, for the daily reminders, the CAPE ratio being at 37, and I want to talk about that a little bit. The CAPE ratio, also known as the Shiller PE ratio, is one that takes earnings, inflation, cyclical things, a whole bunch of numbers together to suggest the potential future returns of the S&P 500. Very notably, we're currently sitting at a level of 37.1 in October 2024. In 1929, the year before the Great Depression, this was at a level of 31. investors did not see a nominal return for decades later. The same thing happened when this was elevated in 1965 at a level of 23. Your stocks didn't break even for, it was something like 10 years. We're actually going to look at that chart in a second. And the same thing happened in 2000. For about 10 years, the market was flat. You didn't see positive returns in your investment for 10 years from these high points, and actually more than 10 years in the Great Depression. Just to show what that looks like on SPX, this is the price of the S&P 500 in the year 2000, being at 1500 in 2000 when that CAPE ratio was really high. We had gotten to that level again in 2007, and then not again until 2013. So it took 13 years to get back up to the same nominal price. This is all while inflation is going up and your money hasn't made any money. The value of your stocks didn't meaningfully give you an advantage until years after, 13 years after 2000. So that was this peak here in the Shiller CAPE ratio in 2000 when it was at 41.42. The previous peak in 1965, only at a level of 24, which is low in comparison to what happened in the year 2000 and low in comparison to what we have to today. Let's see what the stocks were doing from 1965. In 1965 on the SPX, S&P 500, we can see we had a price level of $94 here. And you can see from 1965, we had gone basically flat and hadn't really gone to higher highs. We did go to a higher high by the time we got to 1972, but we didn't. But right after we saw even a lower low than we hadn't seen since the early 60s in 1974. Imagine losing 10 years of market value at that point. But we digress. From 1965, we still had been hitting that point again over, it looks like 12 years later, 1978, 79. And this is again in nominal terms when we finally had the market going up. Notably, during this period in the 1970s, this is when inflation was really high and going through the roof. And yet the S&P 500 was not helping you out if you were invested in it. It was going flat through this period. If you had intelligently recognized the fact that this was very elevated, the CAPE ratio, you could have saved yourself from a lot of pain. And now for the ultimate 1929 CAPE Shiller PE ratio being at 31.50. Quick reminder, right now it's 37 for comparison. In 1929 in the S&P 500, we had a price of 31.53. And as you can see, we had gone down in price going into the Great Depression, and we hadn't gotten to that same level in nominal, in other words, the price number, we hadn't gotten back up to that level until 1954. That was 25 years later. 25 years later of not only no returns, but you would have lost the value of your stocks sitting in stocks still for 25 years. And do you think you could buy the same amount of goods and services in 1953 for the same amount of money as you could in 1929? If you include inflation into this picture, you would not have been feeling good about your investments in 1929 until perhaps the early 60s, 30 years later. When I say I am scared of the valuation of the S&P 500, I'm not exaggerating the least bit. And so red flag number 3 is probably the biggest red flag. This is probably the biggest red flag Second biggest flag is the inversion. Third is probably the SOM roll. And then fourth and fifth are the last ones, and that's what I'll talk about last. Final daily reminders. Rate cuts began September 18th, 2024 with a 50 basis point cut, suggesting that the Fed is actually fearful. And we still have in 2024, 2 more 25 basis point cuts priced into the Fed funds futures, suggesting that the market is expecting more cuts because the market is expecting more evidence of lower inflation and further cooling in prices and in labor. Now, all while this is happening, while we're cutting rates, does that mean that the Fed is now pressing on the gas and trying to accelerate the market? No. We know this because the 3-month 10-year is actually still inverted. And so while the Fed says explicitly, Jerome Powell has said in his meetings, he does not want to see further weakness in the labor market, the Fed is actually still restrictive here. The cuts are simply less restrictive until we uninvert the curve. As long as the yield curve is inverted, as long as the Fed is holding rates higher than what the rest of the market expectations are for yields going into the future, the Fed is still strangling the economy. This is after a 2-year-long period of strangling the economy. And as we get closer to a 2% inflation rate, it has a decent probability of going further in my strong estimation. And this is why I always say that, the Fed cuts, they're not going to be all that effective for actually helping the market go forward. Again, when you have an enormous amount of fiscal debt, monetary policy is less effective in both directions. When it raises rates, it didn't slow down inflation as powerfully as it might have done given a situation of lower fiscal deficit. And equally, as we're cutting, it's not going to speed up the economy as people expect either. And that sums up this week's daily reminders. That's all from me and my crystal ball. Hope you enjoyed. Thank you for watching, and see you next time. Robschild.